So, the most amazing change over the last 15 years, which we've seen happen in recent months, is private equity became our largest allocation. Historically, it was in the low 20s. It's actually 31% now. And real estate, which had been our largest allocation for 15 years, was toppled in the last year and fallen to third place. And obviously, real estate is so interest sensitive in terms of valuation and the ability to generate cash depending on mortgage expenses that our members in our groups all around the world, as earlier as the first quarter of a year ago, started saying that they were pulling back on real estate. And yet, what's amazing is even though we've had this historic pullback, in a recent poll of our members saying where are the opportunities for next year, the number one category with almost 70% of our members was looking for new opportunities in real estate, obviously at the lower price levels that have happened almost across the board.
I mean, I guess your members may be lucky. I mean, you are dealing with high net worth individuals. It's different for institutions, of course, but in this case, it seems like they do have dry powder to deploy, which puts them in an advantageous situation. How are your members thinking about liquidity? Because again, we talk about rising interest rate environment. Are they placing higher emphasis on being involved in more liquid assets so that should push come to shove, they're able to get out of those assets fairly quickly? Or are they comfortable still being positioned in some of the less liquid products, as you mentioned, like real estate and like private equity?
So when you look at the total risk on assets, public equity, private equity, and real estate, you're still in the 78% range. But what's different is historically our members held around 12% cash. This was a fixed number that didn't move for one reason or another. And we're talking about over $100 billion in assets across our over 1,200 members. But in the last year, they've pulled back cash to 10%. And that may seem like a small difference from 12 to 10%. But it does express confidence just at the time that we're talking about a recession. And the only sense we make of it when we ask our members around the world, it's that they're still comfortable for long-term investments that have value. But in the short term, they're nervous about a recession. So they're still holding 10% in cash, both to weather a storm, but also to have the dry powder to pounce on an opportunity. Our members are all former and current entrepreneurs who've built businesses. So they're in a better position to see what an opportunity is when it stares them in the face. Many people can't even see it. My partner used to say the opportunity of a lifetime comes on my desk every week if you're looking for it, and luck tends to favor those who are prepared.
Yeah, I like that expression. Can I ask you what your members are saying about the tech sector in the US? We saw a really strong first quarter for the NASDAQ, much to everyone's surprise, given the performance in 2022. Are they bullish on the sector? Are they keeping some dry powder to buy more at these levels?
I'd say from a long-term perspective, technology remains our second or first category of interest. In that same poll from November asking where do you plan to invest next year, technology was the number two category. Almost 40% of our members looking for technology opportunities. And the answer is where you have a hardware light, a software heavy opportunity, the margins still are quite extraordinary. Some of the consumer names are pulled back, but when you're in the B2B SaaS providers that are running the core of businesses, Salesforce would be a good example. Salesforce is probably going to do well. I'm not recommending Salesforce per se. I'm just saying software has become sort of the backbone of so many businesses. There's still huge opportunities, and our members are quite focused on that.